7 signs you're financially prepared to buy a home. Have you ever dreamed of owning a home, a place to call your own, filled with memories and stability, but wondered if you're truly ready to take on the financial commitment? Buying a home is one of life's biggest milestones, offering security and pride, but it's also a massive responsibility that demands careful preparation. In today's real estate market, with rising home prices and fluctuating interest rates, being financially prepared is the key to a confident purchase. Some buyers step into homeownership with ease, while others struggle, weighed down by debt or unexpected costs. The difference often lies in a few key signs, clear indicators that you're financially ready to buy a home and thrive as a homeowner. In this article, we're exploring 7 signs, grounded in real estate and financial research from reputable sources like the National Association of Realtors, NAR, and studies in Journal of Financial Planning, that you're financially prepared to buy a home. These aren't just checkpoints, they're backed by insights from experts like Dave Ramsey and reports from the Consumer Financial Protection Bureau, CFPB, which emphasize the importance of financial readiness in homeownership. By the end, you'll know exactly what to look for in your own finances, and more importantly, how to solidify your position if you're not quite there. Stay with us until the end, because you might be overlooking critical strengths or gaps that could derail your dream. Recognizing these signs will give you a roadmap to buy your home with confidence. Let's dive in. Sign 1. You have an emergency fund separate from your down payment. The first sign that you're financially prepared to buy a home is having an emergency fund separate from your down payment, ensuring you can handle unexpected expenses without touching money saved for your home purchase. A 2021 CFPB report found that 40% of new homeowners face financial stress due to inadequate emergency savings, with 3 to 6 months of living expenses, $6,000 to $12,000 for average households, recommended to cover job loss or repairs. When you have $10,000 saved for emergencies and $20,000 for a down payment, you're ready to weather life surprises without risking your home investment. Picture 2 prospective buyers, both 30 years old, saving for a $300,000 home. Maya has $15,000 for a down payment but no emergency fund, so a $5,000 car repair forces her to borrow, delaying her purchase. Ethan keeps $10,000 in an emergency fund and $15,000 for a down payment, paying the same repair in cash and closing on his home on time. His preparedness shines. The NAR notes that separate emergency funds reduce foreclosure risk by 20%. Why does an emergency fund matter? Homeownership brings surprises, leaky roofs, medical bills, or layoffs that can strain budgets. A dedicated fund keeps your down payment intact and protects your financial stability. The good news? You can build one now. Save $50 to $100 monthly in a high-yield savings account, e.g., Ally at 4% interest, for emergencies, keeping it separate from down payment funds. If you lack a fund, redirect $25 from discretionary spending, like coffee, to start today. Check your savings. Do you have an emergency fund separate from your down payment, or is it mixed? If it's mixed, a dedicated fund can secure your home purchase. Sign 2. Your debt-to-income ratio is below 36%. The second sign that you're financially prepared is having a debt-to-income, DTI, ratio below 36%, showing lenders you can manage a mortgage alongside existing debts. A 2020 study in Journal of Financial Planning found that buyers with DTIs below 36% are 25% less likely to default, as they have room to absorb mortgage payments. When your monthly debt payments, e.g., $1,000 for student loans and car, are less than 36% of your gross monthly income, e.g., $5,000, you're in a strong position to afford a home. Imagine 2 colleagues, both 35 years old, earning $60,000 annually, $5,000 monthly. Sarah's DTI is 40%, $2,000 in debt payments, making lenders hesitant and her budget tight for a $1,500 mortgage. Ethan's DTI is 30%, $1,500 in debt, securing a $350,000 loan with ease and room for other expenses. His low DTI wins. The CFPB reports that DTIs below 36% improve loan approval rates by 30%. Why does DTI matter? A high DTI signals overextension, limiting your ability to handle mortgage payments or unexpected costs. A low DTI proves you're financially balanced, boosting lender confidence. The good news? You can lower your DTI now. Calculate it. Divide monthly debt payments by gross monthly income, e.g., $1,200 divided by $4,000 equals 30%. If above 36%, pay down high-interest debt, like credit cards, by $100 monthly. If your DTI is high, list one debt to tackle today, like a $2,000 card balance. Check your ratio. Is your DTI below 36% or higher? If it's high, reducing debt can strengthen your home buying power. If you're finding this insight valuable, please comment number 2 below to let me know you're here. And if you haven't subscribed yet, I recommend you subscribe and turn on the bell so you don't miss any articles. Let's keep going. Sign 3. You've been pre-approved for a mortgage. The third sign that you're financially prepared is that you've been pre-approved for a mortgage, giving you a clear budget and lender confidence before house hunting. A 2021 NAR survey found that pre-approved buyers are 20% more likely to close successfully, as pre-approval confirms affordability and streamlines offers. When a lender pre-approves you for a $400,000 loan based on your income, credit, and assets, you know your price range and can shop with certainty. Consider two friends, both 40 years old, looking for a $350,000 home. Emma shops without pre-approval, wasting time on homes she can't afford and losing a bid when her financing falls through. Noah gets pre-approved for $400,000, making a competitive offer that's accepted in a week. His preparation seals the deal. The Federal Housing Finance Agency notes that pre-approval reduces closing delays by 15%. Why does pre-approval matter? It clarifies your budget, strengthens your offers, and prevents heartbreak over unaffordable homes. Without it, you're guessing, risking delays or rejection. The good news? You can get pre-approved now. Contact 3 lenders, e.g., local banks, credit unions, or online platforms like Rocket Mortgage, for pre-approval, providing income, debt, and credit details. Compare rates and terms. If you're not pre-approved, request a pre-approval letter from one lender today. Check your status. Are you pre-approved or shopping blindly? If it's the latter, pre-approval can focus your search. Sign 4. You can afford monthly payments, including taxes and insurance. The fourth sign that you're financially prepared is that you can afford monthly mortgage payments, including property taxes and homeowner's insurance, without straining your budget. A 2020 CFPB report found that 30% of homeowners underestimate total housing costs, with taxes and insurance adding $200 to $500 monthly to a $1,500 mortgage. When your budget comfortably covers a $2,000 total payment, principal, interest, taxes, insurance, while leaving room for other expenses, you're ready for homeownership's full cost. Picture 2 neighbors, both 45 years old, buying a $300,000 home with a $1,500 mortgage. Sarah budgets only for the mortgage, but $400 in taxes and insurance pushes her total to $1,900, forcing her to cut savings. Ethan budgets $2,000, covering all costs with $1,000 left for other expenses, staying stress-free. His foresight prevails. The NAR advises keeping housing costs below 28% of gross income to avoid strain. Why do total payments matter? A mortgage is more than principal and interest. Taxes and insurance are non-negotiable, and underestimating them risks financial overload. Affording the full payment ensures stability. The good news? You can estimate costs now. Use a mortgage calculator, e.g., Bankrate, to project total payments, adding 1 to 2% of the home's value annually for taxes and insurance, e.g., $3,000 to $6,000 for a $300,000 home. If payments exceed 28% of income, save more or target a cheaper home. If you're unsure, calculate costs for one home today. Check your budget. Can you afford full payments or just the mortgage? If it's partial, budgeting for all costs can prepare you. If you're still with me and finding this valuable, please comment number 4 below to let me know you're here. Your support keeps us going, and I'd love for you to subscribe and turn on the bell to stay updated with more insights. Let's continue. Sign 5. Your income is steady and predictable. The fifth sign that you're financially prepared is having a steady and predictable income, providing the reliability lenders and your budget need for long-term mortgage payments. A 2019 study in real estate economics found that buyers with stable income are 30% less likely to miss payments, as consistent cash flow supports housing costs. When you've had a salary job, consistent freelance income, or a stable business for at least 2 years, you're in a strong position to handle a mortgage. Imagine 2 buyers, both 50 years old, seeking a $400,000 home. Ava's freelance income fluctuates, averaging $4,000 monthly but dropping to $2,000 some months, making her $2,200 mortgage payment risky. Liam's $5,000 monthly salary is consistent for 3 years, easily covering his $2,200 payment with surplus. His stability secures approval. The CFPB notes that lenders require 2 years of steady income for approval, reducing default risk by 25%. Why does steady income matter? Mortgages are long-term. Unpredictable income jeopardizes payments, risking default or stress. Stable income ensures you can plan confidently. The good news? You can assess stability now. Review your income. If it's varied by less than 20% monthly for 2 years, you're stable. If inconsistent, save 6 to 12 months of expenses or diversify income streams, e.g., a side gig. If your income is unsteady, track 1 month's earnings to identify patterns today. Check your income. Is it steady and predictable or erratic? If it's erratic, stabilizing income can boost your readiness. Sign 6. You've accounted for maintenance and unexpected costs. The 6th sign that you're financially prepared is that you've accounted for maintenance and unexpected costs, budgeting for repairs, upkeep, or emergencies that come with homeownership. A 2021 NAR report found that homeowners spend 1 to 2% of a home's value annually on maintenance, $2,000 to $4,000 for a $200,000 home, with unexpected repairs averaging $1,000 to $5,000. When you have a plan to cover a $3,000 roof repair or $500 monthly landscaping without disrupting your budget, you're ready for the realities of owning a home. Picture 2 siblings, both 55 years old, buying a $350,000 home. Sarah doesn't budget for maintenance, so a $4,000 HVAC failure forces her to use credit, adding $600 in interest. Ethan budgets $5,000 yearly for repairs, paying the same fix in cash from a sinking fund. His planning prevents debt. Dave Ramsey advises a maintenance fund of 1 to 3% of a home's value to avoid financial strain. Why do maintenance costs matter? Homes require ongoing care. Unplanned expenses can deplete savings or lead to debt if you're unprepared. Budgeting for them ensures resilience. The good news? You can plan now. Estimate 1.5% of your target home's value annually for maintenance, e.g., $4,500 for a $300,000 home, and save $100 monthly in a dedicated account. Research local repair costs, e.g., plumbing, roofing, for accuracy. If you haven't planned, set aside $50 for a maintenance fund today. Check your prep. Have you budgeted for maintenance or ignored it? If it's ignored, planning for costs can protect your finances. Sign 7. You have a clear budget for furnishings and moving. The 7th and final sign that you're financially prepared is having a clear budget for furnishings and moving, covering costs like furniture, appliances, or relocation expenses that arise after buying a home. A 2020 study in Journal of Consumer Affairs found that 35% of new homeowners underestimate post-purchase costs, spending $5,000 to $10,000 on furnishings and moving, often relying on credit. When you've saved $3,000 to $7,000 for a couch, fridge, or movers, you're ready to settle in without financial stress. Imagine 2 buyers, both 60 years old, moving into a $400,000 home. Ava doesn't budget for furnishings, charging $6,000 for furniture and movers to a credit card at 18% interest, costing $1,080 extra. Liam saves $7,000 in a sinking fund, buying essentials in cash and moving smoothly. His foresight saves him. The NAR estimates new homeowners spend $4,000 on average for initial furnishings and moving. Why do furnishing budgets matter? Moving into a home brings immediate costs. Without a plan, you risk debt or delaying essential purchases, dampening your homeownership joy. A clear budget ensures a smooth transition. The good news? You can budget now. Estimate $3,000 to $5,000 for furnishings and moving, adjust for home size, and save $100 monthly in a dedicated account. List one item, like a $1,000 sofa, to prioritize. If you haven't planned, save $25 for moving costs today. Check your plans. Do you have a furnishings budget or none? If it's none, budgeting can ease your move. Final thoughts. Now that you know these 7 signs, having an emergency fund, a low DTI, mortgage pre-approval, affordable full payments, steady income, maintenance planning, and a furnishings budget, take a moment to assess your own financial readiness. Are you poised to buy a home with confidence, backed by savings, stability, and clear plans? Or do you see gaps, like no emergency fund, high debt, or unplanned costs, signaling you need more preparation? The good news is that readiness is within reach, and every step strengthens your path to homeownership. Buying a home isn't just about signing a mortgage, it's about building a foundation for your future, filled with security, pride, and memories. A financially prepared purchase means less stress, more affordability, and the joy of a home that fits your life. Don't rush into a commitment you're not ready for. Start today, save $50 for emergencies, calculate your DTI, or get pre-approved. If you're not fully prepared, pick one sign to address and watch your readiness grow. Every choice, whether it's budgeting for repairs or securing a low rate, moves you closer to your dream home. Prepare financially today, and watch your homeownership journey shine tomorrow.